Holy Coinbase. I mean, Coinbase stock, first of all, it's COIN stock. Well, first of all, cool names, coin stock. They're set to go public later this week, and they put out incredible first quarter 2021 guidance. I mean, just mind-blowingly good numbers. Just amazing. And let's, you know what, it's so good. Let's actually jump right into it right now so you can see how incredible their results are, because right now the valuation for Coinbase is somewhere like 100 billion, 140 billion. It hasn't started trading yet, but that's sort of the rumored valuation range. And so, like, how is it possible for you to have a company that's already at this 100 billion plus valuation? It's private though. And so seeing mind-blowing numbers like you see with their first quarter does sort of give credence to the valuation. But it does create bigger questions, which we'll get into a second. Let's go quickly into their financials so you can see what I'm talking about. Where this is their first quarter 2021 revenue update. So they're saying their monthly transacting users, because the way to think about Coinbase is it's effectively a trading platform, where in a wallet for you to hold your crypto assets, for you to buy and sell cryptocurrencies. And so here it is, monthly transacting users, 6.1 million in the first quarter. This compares to how they did at the year end 2020 of 2.8 million. So 2x plus, doubled in the first quarter. Second key point, total revenue in the first quarter of 1.8 billion versus total revenue for the full year of 2020 of 1.3 billion, a little under 1.3 billion. So they're already 1.4x their revenue just in the first quarter alone. So this is what I mean by, you know, there's obviously, it's obviously exciting to watch companies go up or to look at valuations expand. Oh, $100 billion valuation. But the reality is there's multiple components to this, and you have to update your valuations when you see incredible financials, incredible fundamentals. And that's what I'm talking about here with this video. I'm saying, holy Coinbase, like, look at these numbers where their revenue in the first quarter was 40% more than what they did all of last year. And that's only one quarter of 2021. Then their net income was, they're guiding to 700 to 800 million. This is profits that they're guiding to. An IPO that's going to be very profitable for all those SPAC investors that are like, hey, this will be profitable sometime by the time I'm a grandparent. Here it is. They're saying, look, our profits are 2x what we did all of last year, all in one quarter. So this is mind-blowingly good numbers. And so the hype, this isn't just sizzle. The amount of folks that are excited about this situation, I would argue there's fundamental backing for it to get people interested. But, you know, you want to temper it. You want to ask yourself, well, wait a second, like, you know, how sustainable is it? And we'll talk about that in just a second. So, you know, I did a video on in terms of a detailed dive in terms of how Coinbase's business model currently works, if you want to actually learn about the details of it. So you need to click on that video if you want to, you know, get the full download. But when you see financials, and this is why investing is, in my opinion, is such a fun journey, is that normally you don't have to update dramatically each quarter. You know, normally you could checking up with a company each quarter and you're sort of saying to yourself, well, you know, oh, okay, it's growing along what I expected. But when you have something like this, where in one quarter you far surpass your numbers that you did all of a prior year, you gotta go, okay, maybe I need to revisit my thesis, or at least revisit the financials, because I don't think anyone was expecting that strong of a financial performance. So this is what investing is. You have to constantly, you know, when the facts change, you should change your mind. Now that doesn't mean you should buy into the hype and be like, yes, just buy it up. You still need to anchor everything with reality and what you think a company will do in the future. But when, you know, a company posts incredible numbers, yeah, the valuation inherently should expand, one would expect, unless it was overpriced to begin with. So let's, you know, here's an updated valuation range based on this around $140 billion valuation, supposedly around 550 share price. It's going to be a direct listing later this week. So you can see annualized, based on their first quarter results, you get this high scenario of around $7 billion in revenue, which is just incredible. I mean, you're talking about 465% revenue growth in 2021. That would be fantastic numbers for them. That would be a dramatic acceleration from what they did in 2020, where their growth was 140%. Now, I also look at it, whenever I do a valuation range, whenever I do this hypothetical valuation range, I want to consider also more conservative situations. And so here it is, putting in, let's say, only 4.4 billion on the upside in the low scenario. So 4.4 billion in revenue for 2021, hypothetical revenue for 2021, which is only 250%, only 250% growth. If only we could only all grow our revenue by 250% in any given year. But, another key aspect of this is that their profitability, their margins, they've shown, look how profitable we can be as a company. With this, if you're at 800 million in net income on 1.8 billion in revenue and 1.1 billion in EBITDA, that means your EBITDA margin's like 60%. So going back to the valuation, if I do a range of 40 to 60%, that does have an important flow through to the valuation. Previously, I was looking at a lower valuation range. Now, one could also argue, well, wait a second, they've targeted, and I talked about this in the prior video, they've targeted effectively being break even longer term, and they're going to take any sort of windfall profits and reinvest it in the coming quarters. So, is it possible that when we're looking at these margins, in the first quarter, where they're saying, hey, we're at 60% EBITDA margin in first quarter 2021, is this sort of surplus? Is this a margin that they're not going to be able to repeat in the future? And it's definitely something to think about, and that's why I do what I'd argue is a pretty wide range. Now, it could be even lower, especially given that they said they're targeting break even for several years. So 40 to 60% is quite a wide range. Then the big question is like, well, what's their growth rate? We'll talk about this wide range that I'm using in a minute, but you can see on the low side, I'm saying 20% annualized growth rate over the ensuing 4 years. This is on top of this incredible growth in 2021 of, a range of, let's say, 250% to like 470%. So this annualized growth rate of somewhere between 20 and 50%. We'll talk about that, as I mentioned. And so then the big question is, well, what's the valuation in 5 years from now? Because I try to take a long-term view with all my investments. And so, if your annualized growth rate in the ensuing 4 years beyond 2021 is closer to 20% a year, then you're probably going to get a lower multiple than if your annualized growth rate was 50% in the ensuing 4 years after 2021. And so that's the reason why I'm assuming a different end multiple 5 years out from now, which is 20 to 35 times multiple. Could it be higher or lower? Absolutely. And that's, I leave that to you, and that's part of the reason why if you click on the description, you click on file download, there's a link to this, so that if you want to play around with it, you're welcome to. But you could see that relative to a lot of other setups, you don't see a lot of things like this, where there's sort of dramatic upside potential if they continue to execute, if they continue to deliver on what is arguably amazing growth numbers, amazing growth, amazing profitability, saying 300% plus upside from a $140 billion valuation. I mean, that's already incredibly rich. I mean, this valuation was something like 50 billion, something like a year ago. So this valuation's already gone up a lot, but wait a second, so have the fundamentals. The fundamentals are incredible so far. The downside, as I'm also, penciling out and thinking about, is that the downside could also be very significant if you don't deliver on continued fantastic growth in the years ahead. If you get more of a normal multiple, normal, much lower growth, yeah, your end valuation could be a lot lower than this starting IPO valuation or direct listing valuation of around 140 billion that is rumored to come out at. So this is an interesting setup, but there's a lot more that I want to understand in order to really, be willing to pull the trigger, especially when you're saying, hey, 300% upside, this is the type of multi-baggers that I look at. And if this is your first time, tuning in, my name is Daniel. This is unrivaled investing, and this is exactly what this is the type of setup that I'm normally looking for. I'm looking for, potential multi-baggers, types of situations that could go up hundreds or thousands % over time. And so this is the type of thing that gets the wheels moving in my head, saying, hey, could this be it? And so there's a lot more that I'd want to understand to get me to sort of pull the trigger for myself. And this is some of the stuff that I've previously articulated in that first video. I'll leave a link to it in the comments below. And so, my first question as I look at this is, why are they unrivaled? And that's the basis of this channel, which is I want to find exceptional companies that have the right to win over time. And in the last video that I did on it, now sure, they do have this brand recognition that has made it easier for them to attract capital, where just a huge percentage of new customers coming in come in because of this sort of word-of-mouth referral. That's a huge advantage. It's a huge cost advantage in terms of bringing these customers. No wonder why they're so profitable. People go, oh, if I want to start trading Bitcoin, I'm going to go to, Coinbase. This is the platform that I'm going to go to, because of that sort of mind share that they've captured. So that's a huge asset for now. But more institutions around the world are enabling crypto trading every month. For example, SoFi, which I've done a video on as well. And it's often for much lower costs than what Coinbase is offering. So isn't this a risk to their long-term growth rates and margins and valuation? So doesn't that sort of take away or potentially discount that prospect of that upside scenario? That's something I'd want to understand better, because from the feedback I've gotten so far is that if you're serious about wanting to trade or own Bitcoin, there's actually several other sources that are much more affordable, much cheaper take rates than what you get with Coinbase. How much of their current growth is just speculative fervor? I mean, this type of, straight up hockey stick performance. This is the type of things you see in very ebullient markets, where it's just like, yes, I want to trade these cryptocurrencies. How much of these crypto transactions are actually based on a real exchange of goods versus sheer speculation? Because if this is sheer speculation, one would argue that this valuation range, if this is sheer speculation that we are having right now with these crypto assets, and that's honestly what my big fear is here, is that a lot of people are just getting greedy because interest rates are so low, and they're looking for things to get some sort of return and looking for some sort of Momo. They're putting it in crypto assets, and as a byproduct, the picks and shovels plays of the crypto assets are making a ton of money, and that's Coinbase, where they're making a ton of money. But you know what? You could also have a bust. And that's the concern is, well, wait a second. What's the risk that this actually busts out because this is purely speculative? How many of these transactions are actually people doing some sort of real exchange of goods versus people just saying, hey, this is the currency, or this is the crypto asset, cryptocurrency I'm going to own, and it's purely based on the expectations that someone is willing to pay more for it in the future, versus, hey, I want to own this in my account because I want to go exchange this for this good or service in the future or right now. So I strongly suspect a lot of it's just, I suspect someone's going to be willing to pay more. And that game is a very, very tricky game to play, because you're constantly thinking, hey, someone's going to be willing to pay more for it. And so if it is speculative fervor that's driving all this, then I would say this framework, you can toss it out the window, and this thing could go a lot lower. So that's a big question, and that's why this is a hypothetical valuation framework, where the underlying fundamentals and business can go way higher and way lower than this. But it is an interesting setup. Don't get me wrong. Their first quarter numbers were phenomenal. So the first question is, how do they handle new competitors that effectively are coming in at lower cost? The second one is, what's the risk that this is just speculative fervor that sort of just blows up over time? And then the third, I think the third key question is, while crypto traders benefit from a company that does everything above board, tries to do everything, meet the letter of the law, there's a non-zero risk, meaning there's a real risk that governments around the world, and you've seen headlines from this, from various different countries, saying, hey, we're going to ban cryptocurrencies in exchange for either our own currency, digital currency, or just saying, hey, you have to use our own currencies, we're going to either tax this to the moon or just outlaw, prohibit it. And that's not without precedent. In the Great Depression, for example, it was outlawed to own gold. If you had it, you had to, transfer, bring it into the government. You had to sell it back to the government. So, you see situations like this. And so what's the risk that you have something like that? And in the case of Coinbase, would an unregulated entity technically be safer from this government intervention risk? The risk that governments, because, hey, the power to print money is probably one of the strongest assets that many countries have, or a handful of countries have. And to be able to print currency, to be able to say, hey, you're going to use our currency, this thing that just came off the printing press, and you're going to believe this $100 bill is worth something. That narrative is worth a lot of intangible value. And so over time, there is a non-zero risk that governments around the world do ban this. And in that case, the companies like Coinbase that have operated and met the regulations, said, hey, we're going to follow all the rules. Well, the rules just changed. And now everyone with an account at Coinbase, you're in a tricky position. And so would you be better off with the wallets, the digital wallets that are like, oh yeah, we're not going to be regulated by the SEC. We do not have to meet any sort of US financial, legal framework. There's obviously the trade-off is like, well, wait a second. There's a reason why the U.S. legal framework is there. You don't want, let's say, Ponzi schemes. And I'd say with a high degree of certainty that there are Ponzi schemes with crypto assets right now. Like the fact that there are so many, hey, you can get this 14% yield in crypto assets. And hey, how come you're able to do this? That is Ponzi scheme financing. Just something to think about, food for thought. I think that risk is definitely material for people to be considering. And unfortunately, that's a byproduct of being in a low interest rate world. So these I'd argue are the key questions I would be thinking about Coinbase, even though it does seemingly have an attractive or seemingly attractive risk reward of potentially up several 100%. And that's what I'm focused on here with Unrivaled Investing, where I'm trying to find these potential multi-baggers. So if you like learning about potential multi-baggers, make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to see what potential multi-baggers I actually am buying, I do about 4 posts every month, maybe a little bit more, where it's my potential multi-bagger each month. And so each month you can see what's the company that I'm calling out, my full portfolio detail. And that the truth is those are the types of setups I'm looking for. I'm looking for companies where instead of, let's say, maybe downside of 60% plus, I'm looking for break even and still have 200% upside. And that's honestly what I'd like to find. And we're trying to build a community here with unrivaledinvesting.com, and there's lots more exclusive content, like educational content for those that are interested in learning about stocks. So if this video has been helpful for you, please make a point of subscribing, hitting that like button, and thanks so much for watching.